Hey, all right. So somehow we got flagged for hate speech. I'm not sure how talking about the mortgage
Oh,
is
really?
considered hate speach, but
Well, maybe it was because, lower credit scores. Who knows?
I don't know.
Anyway, you know, I think they're trying to make it more competitive with FHA, which is probably a good thing. I do think a lot of these credit scores are still going to go FHA. But again, we'll put some numbers or some links down in the chat, and people can check it out for themselves. I would not. Number one, I had somebody ask me, "Hey, should I tank my credit score to get a better deal?" It's like, no, absolutely not.
Absolutely not.
You know, that we've got to correct that notion. And so, yeah, a lot of there's a kernel of truth to what has happened. There have been some people's pricing is a little bit worse than it had been in the past, but in general, it's not the way it's been put out, especially on social media. So.
Yes.
Hopefully we can correct that. Yeah. I'm sure.
I've seen a lot. So just to kind of recap, since we did our first live got cut off, we're talking with Michael McCollum of Certainty Home Lending. He's been in the business for about 16 years. And we were in the process of talking about the new mortgage rates and adjustments and all of that before we got cut off the first time. So, all right, so let's talk about what the rates are today. What's an average rate that we're looking at right now?
Rates are in the sort of low to mid 6 range, you know, for good credit, or you know, FHA. FHA is not nearly as punitive on lower credit scores. So FHA is a really good, you know, product for first-time home buyers to look at. It's 3.5% down, but those are usually in the low 6s, you know, depending on credit and that kind of thing. But, you know, the market's moving every day, so it's hard to say exactly. And you've got to factor in these, especially on conventional, these loan level price adjustments. So depending upon how much somebody's putting down, what their credit score is, that's going to usually determine what their rate is.
Okay. So I want to add in a question that I didn't send you earlier. So how do you go about determining what loan option is the best for a potential buyer?
That's a great question. I'm glad you asked it. So I position myself as a mortgage advisor or a mortgage coach. And I'm not just a rate quoter, and I'm not just the guy that's going to close you on time, which, you know, we're going to do a good job of that. But what we like to do with our clients is give them options. And so we can sit side by side on a tool we have called Mortgage Coach, where somebody could see, here's an FHA loan, here's a conventional loan with maybe 3% down or 5% down, FHA with 3.5% down. And they can sort of look side by side and see which gives them the best value, which gives them the lowest total cost over time. Sometimes the lowest rate does not have the lowest cost over time because of other things that are involved. So, you know, we try to do that with every client with a tool that we have called Mortgage Coach. It's my job to figure out, okay, what you qualify for. You know, I mean, some people may not qualify for a conventional loan, and we've got to go FHA. But assuming they can qualify for a variety of loan programs, we'll sort of use Mortgage Coach to show them what their options are, and they can determine which one's best. You know, whether it's maybe what's most important to them is down payment, cash to close, monthly payment. They can sort of find the sweet spot that meets their particular financial needs.
Okay. Awesome. So let's talk about the different types of mortgages that are out there. As far as conventional, FHA, USDA, and VA, and how obviously VAs are going to be for veterans, so not everybody's going to be able to fit into that category. But how do the different loan programs work? And how do you, so if you were to qualify for conventional, USDA, FHA, how would you go about deciding which one was the best package for a potential buyer?
Sure. Good question. So with conventional, there are conventional products with as little as 3% down. And the main value of conventional is that if you're putting less money down, you're going to have private mortgage insurance as part of your payment, but that PMI will drop off in time as the house appreciates and as you pay down the mortgage. And it gets cheaper depending upon your credit score and how much you put down. So if you're putting 15% down, it may be a very minor thing that you didn't, it doesn't matter that you didn't have the 20% down. Some people think that you can't go conventional unless you put 20% down. But again, that's incorrect. You can do as little, sometimes it's 3% down. Sometimes to do that, you got to have you might have to be a first-time buyer. There's a couple of different 3% down options. But that's I think that's the main benefit of a conventional loan is the PMI with low money down will drop off in time. You don't have to worry about refinancing to get rid of it. Usually your conventional buyer with good credit they're going to probably get a little better deal than with FHA if they've got good credit. FHA though, if your credit's sort of mid-level or maybe a little bit on the lower side, FHA can be a really great way to go. It requires 3.5% down. The mortgage insurance is on there for life unless you put at least 10% down. So that's one of the more negative things. But if you think, I may not be in the house that long, it probably is not going to matter. And you're still going to get a really good rate, even if you're not a top level credit score. With USDA, obviously it's a geographically restrictive loan. You got to be buying in a USDA area. They're a little bit tighter on ratios. So you may have a client that's trying to decide between FHA and USDA, and it'd be great to go no money down, 100% financing with USDA, but the ratios don't quite allow that. I should say that's a positive of FHA. FHA is much more forgiving on ratios, much more forgiving on credit, and so that sort of steers people that way sometimes. On the veteran, I think a VA loan, 100% financing, no mortgage insurance on a monthly way. You do have a funding fee. And if it's their second go around, that can be, substantial amount. If they have some type of disability related to their service, that'll be waived. So that's really good. But if you've got, a 2 or 3 time buyer who has their VA benefit, but now they're looking to put money down, conventional could be the better way to go because they can avoid dealing with the funding fee. Okay. So again, we look at all options. There's pros and cons with everything you do in life. There's some trade-offs, and you just got to figure out again what's the sweet spot for that particular client. And it's certainly not a cookie cutter industry. It's a matter of looking at each person's situation and saying what's best for them. Right.
So I'm going to throw in another question here regarding VA loans. Something that I see in my industry is you have agents who will, not going to say that they're going to steer their client away from FHA buyers or VA buyers, but you do have some that are a little more standoffish when it comes to accepting a contract on a property where the buyer is going to be either FHA or VA. Now, obviously, when we're talking about a veteran, I feel like, hey, they've earned that right. They've earned those benefits. It's not a bad loan. It's not going to be difficult, but I know there are some houses out there that will not qualify for FHA or VA financing. So can you kind of elaborate on that a little bit?
Yeah. It's a little bit of a sore subject. Certainly over the last couple of years where VA and FHA, we felt like were sort of discounted by sellers. And I think the thing I would say to potential sellers and listing agents is that some of what they think is the difference between that and conventional is not nearly as big a divide as they may think, especially when it comes to the condition of the property. There are some things that you can be stiff for with VA and FHA that you won't conventional, but if it's something sort of major, you're going to have to deal with it on a conventional loan as well. I think there are things about FHA that, it just makes it an easier loan to get done. And so I think, compared to certain conventional buyers, it's really, to me, it's really about the substance of the offer. What is the seller net? And that they wouldn't necessarily reject that out of hand. I would say that one of the products that we have, not every lender has them, is we do renovation loans for both conventional, FHA, and VA. So if there is an issue with the property that makes it difficult to finance as is, we can always look at it as a renovation loan and address that, close it as it is, put the money aside, and address that post-closing. So still a great option to, when we run into that kind of obstacle.
Okay. So I have just a few more questions here for you. So when you're looking at a buyer who's coming in and, maybe they're shopping lenders, trying to decide which lender to go with, these might be some questions that they would ask. So, are your rates, terms, fees, and closing costs negotiable? Are those set in stone 100%? We don't change them?
For the most part, we don't change. And what's happened in the lending world in the last 12, 18 months, obviously 2020, 21, because of COVID, huge refi opportunities. Every lender had more business that they could handle. They had to staff up, bring in people. And I guess really 2021, yeah. And then beginning of 22, we started seeing rates go up, right? Mm-hmm. And so last year was really tough year in the industry. Still, we're in a tough spot in a lot of ways. And so every lender, we got all of these lenders geared up for great business, and all of a sudden the spigot was turned off. So now every lender is chasing there. For every deal that's out there, there are tons of lenders chasing that deal. And so every lender has had to get as lean and as mean as they possibly can just to be competitive. So there's not nearly the margin that we might have had in the past to be able to, do a lender paid, aspect, or reduce a rate by so much where we might have to, we talked about those loan level price adjustments. Maybe a lender in the past had some room to sort of help take care of some of that. Whereas now that may not be nearly as possible. So every deal stands on its own merit. We're all hungry. We all want to get every deal we can, and we will get as lean as we can. But as a general rule, our lender fees are $1,290. That's pretty standard. I think most lenders are around that, a little bit more, maybe a little bit less. And then the rates are really just driven by what's going on in the market on that day.
All right. So do you offer discounts for things like doing inspections, home ownership classes, or if we do, like if you have somebody who sets up automatic payments, right. Are there any discounts that are given for those things?
As we're what's called a correspondent lender, an independent mortgage bank, so we will not service a loan post-closing. So they certainly can set up online payments, but there wouldn't be any discount ahead of time. The only thing that I have that would fit that bill, we do offer a home equity line of credit, and if they set up automatic payments on that, it's through a credit union that we have a relationship with. If they join that credit union, they can get a discount on that rate. But on a regular first lien mortgage, the online payments would not impact. In terms of discounts on if somebody does an inspection, we don't do anything like that. We do have some loan products, though, that require home ownership classes. And in all of those products, I say all of them, I'm pretty sure all of them, they are a discounted rate compared to what they would do if they did something just regularly. Okay. So there are some built-in loan products that have that discount, and they also require the first-time home buyer course.
Okay. Okay, so we talked a little bit about the private mortgage insurance.
Yeah.
So how do you determine who has to pay that, how long they pay it, and about how the amount of that is calculated? Gotcha.
So PMI, private mortgage insurance, is for a conventional loan when you put less than 20% down. And it's dictated by credit score and your loan to value. So somebody who's putting 3% down, their PMI may be higher than the person that's putting 5% down. That's higher than somebody who puts 10%. That's higher than somebody who puts 15%. So it changes every 5 in essence. And depending upon how long they take it, depends on a couple of, or have to pay it, depends on a couple of factors. One, do they prepay their mortgage at all? Do they prepay principal so they're paying down their mortgage balance sooner than prescribed? And how much appreciation do they get in the house? Now, by law, it has to drop off when you hit the 78% of the original sales price. When your loan amount gets to 78%, it has to go away. At 80%, you can sort of raise your hand to your servicer and say, hey, I'm at 80% based upon my original sales price. What do I need to do to get it removed? And, they should respond accordingly. The thing that there's not really any set standard on, and it's somewhat servicer to servicer, lender to lender. What do you do for the client who put 5% down or 10% down, and a few years later, as we've seen here lately, their house is worth $100,000 more, and so now they're, from a loan to value standpoint, based upon their current value, they're way below 80%. How does that work? Well, again, you got to raise your hand to your servicers and say, hey, I don't think I should be paying PMI anymore. What do we need to do? So most servicers want you to at least make 2 years of payments. Okay. So I think at a very minimum, you're going to be looking at 24 months of making a PMI. Okay. You got to make on-time payments. If you've been late on anything, they probably say, nope, you got to keep paying. But then it's really up to them to determine if they're, you might have to pay for an appraisal and justify that your value is higher and what your accurate loan to value is. And oftentimes that servicer, they have their own appraiser, so you'll have to pay for that. Okay. But it's somewhat of a negotiating kind of thing. By law, again, if you work at the hard numbers based on the sales price, 78% automatic, 80% if you raise your hand and ask. Anything less than that, based upon the current value of the home, if they reach out to you and say, hey, Grace, can you give me a comparative market analysis? What do you think my house is worth now? I bought it 18 months ago or 24 months ago. I think I got plenty of equity. I'd like to be able to see about, you could provide them some tools that they could then go to their servicer and just say, hey, I think I should be able to get rid of PMI. How do I go about doing that?
Okay, cool. All right, what about the escrow requirements? So do you require those on all loans? Do you leave it up to the buyer as to whether they want an escrow account?
Yeah. Good question. So on government loans, FHA, VA, USDA, the alphabet soup ones, they all require escrow. So you're going to pay your taxes and insurance through your escrow payment. When you have a conventional loan, if you put 20% down or more, we allow you to waive escrows if you would like. We talked about LLPAs, loan level price adjustments. Fannie and Freddie say if you waive your escrow, there is a quarter point, pricing adjustment on your rate. It's not a quarter point to the rate, it's a quarter point to the price. And that's real important, back to that whole LLPA conversation, that those adjustments are always in price, not necessarily rate. And that might be a whole other conversation to explain that. But nonetheless, at 20% down, you can make the choice if you want to not do it. But basically, every lender wants, if you're doing an escrow account, you want enough money in that account to cover the next year's tax bill, the next year's insurance bill, plus a 2-month cushion. So usually a lender is going to send out an escrow analysis report every year and sort of document, hey, you've been paying in, here's everywhere you put money in, here's where we paid the taxes, here's where we paid the insurance. Oh, wait a minute, here's your low water mark, and you're a little bit below, and so we'll ask you to sort of beef that up. And they'll either do that, through stroking a check and bringing it current or bringing it up to the level they want you, or they usually will divide that number by 12 and let you catch up over a year's period of time. Okay. But you're always going to have it on government loans, on conventional, totally up to you once you're at 20%. If you're doing less than 20%, it's a requirement to go ahead and do escrow as well. Okay.
So one last question for you. You and I had talked that y'all had kind of noticed, I don't know if it's been going on for a while, or if it's just been something new, that when you guys do a hard pull on somebody's credit, that all of a sudden that information is being sold by the credit bureaus. And then now this person who came to you and gave you their information and you did a credit check and you're working with them, now they're getting all these calls from other mortgage lenders. So can you kind of explain what that is and then what options buyers have to protect themselves from getting all these calls?
Great question. So when we do a hard credit pull, every lender has what's called a credit vendor. That they're a third-party company, and they will, we request the credit report from them. They go to the 3 bureaus in a matter of, seconds practically. It's all joined together in a tri-merge credit report. Well, Experian, Equifax, and TransUnion then notified that Certainty Home Lending, or we pulled credit. So they then take that information and sell that to other lenders, sort of as what's called a trigger lead. So if you were to have your credit pulled today by a mortgage company, that's sort of a buy sign that, hey, you're in the market to get a mortgage. So the bureaus, it's a revenue stream for them, and the disconcerting thing on our end is we pay for that credit report. So we're giving them money, and yet they're taking that and trying to create competition. We welcome competition. We don't shy away from that, but it can be very annoying for a buyer, because we've had some buyers tell us, I got inundated with 20, 25, 30 calls, after you pull my credit. And they think it's us, and it's really the bureaus who are selling that, information. So a little, it's an annoyance. One of the things that you can do to keep from that, we do a soft pull initially, gives us a nice snapshot of where a client is, just sort of see where they're at. Before we do the hard pull, or even before we do the soft pull, if they wanted to, they can opt out. So it's basically sort of getting like your name on a no call list, essentially. And so they can do that online. They can call in, get the name added. Usually takes maybe 3, 4, 5 business days to sort of get that in. And then when we do the hard pull, the bureaus then are going to sell that information, and they're not going to be called by these other lenders who may be, on those those trigger leads. Yes. Those companies are paying for that as well, right? So, right. So anyway, when they get sold by the bureaus, but they could sort of be opted out of that, and maybe we can put a link, down below the chat that where somebody could do that. Yeah. That just sort of takes care of it.
And would you recommend doing that like now? Should we all be doing that, or is that just something?
Yeah, I think anybody that's thinking about, pulling credit soon to get pre-approved for a home purchase, they could be proactive, and, whether we pulled it here at Certainty or they use somebody else that they already have a connection with, that would still help them regardless. So we certainly can make that available. Yeah, I don't think you have to wait on it. You could just go ahead and do it now. But if you're planning on doing something soon, it wouldn't be a bad idea to, go ahead and make that opt-out call.
All right. Well, let's do one more thing, and we'll wrap up, since we did get cut off at the beginning. If you could just quickly go over the loan level price adjustments and how all of that in the news again, that, they're making it out that people with good credit are going to be penalized and people with bad credit are going to be given better rates. So just real quick, if you could just recap what you had said at the beginning since we got cut off.
Okay, no problem. So Fannie Mae and Freddie Mac, the two government-sponsored entities that sort of handle conventional loans, they have a matrix, if you will, called a loan level price adjustment. And basically it just sort of shows that depending upon what your credit score is and how much money you're putting down, there is going to be an adjustment to the price of whatever rate an individual is getting. So the bottom line is that if your credit score is high, you're going to have a lower price adjustment than somebody who has a lower score. Their price for the same rate that you're going to get is going to be a little more expensive. They can either pay that up front to get the exact same rate you get, or they can say, I don't want to pay that money, and therefore the lender says, okay, no problem, we'll bump your rate a little bit so that you don't have that same upfront fee. So the 780 score gets a better rate than the 720 score at the same, loan to value. So the idea that anybody who has a higher score is getting a worse deal than somebody who has a lower score is patently false.
Okay.
The news came out that the net change from where we are today compared to where we were a year ago, there are some pricing adjustments at certain credit scores and certain down payment amounts that have gotten worse, while people maybe with a lower credit score has gotten better. And it's basically just sort of leveling the playing field a little bit, whereas before, it may have been really, this person got just hammered on their rate and their pricing compared to this person. Now they've come up a little bit. And I think, again, I think I mentioned this, I think it's Fannie and Freddie's desire to try to be a little more competitive in those lower credit scores for those clients who immediately just were going FHA because FHA was such a better deal. So it's an opportunity for them to try to tap in to sort of more the first-time home buyer market, sort of the lower credit score market. But again, if you have a higher credit score, you're still getting a much better deal than the person who has a lower score than you. There's no doubt about that at all.
All right. One more question I just thought of.
Okay.
I know I have done a couple deals with you where we've done a buy down on that interest rate because it is a little bit higher.
Right.
And I think we're seeing people kind of come to grips with the fact that we're probably not going to have a 2% interest rate, maybe ever again.
Right.
And so can you kind of briefly explain what that buy down is and kind of how it works, and why it might be a good incentive, especially right now for some buyers?
Absolutely. So definitely, we've got two problems in the industry. I think you would agree. Number one, we have an inventory problem. We don't have enough homes. We don't have enough home sellers for as many home buyers as we have. And when you have an inventory problem, prices are elevated, right? I mean, we've seen that over the last few years where prices have really gone up. So in the past, 2020, 2021, rates were so low, the fact that prices were going up, it didn't really matter as much because rates were so low, homes were still fairly affordable. Now, as rates have gone higher, along with the higher price, we have an affordability issue. So how do we solve that? Well, the idea of a buy down is a way to address that issue. And there's two different types of buy downs. There's a temporary and there's a permanent. And you can actually do both. So your temporaries, you might have heard somebody talk about a 2-1 buy down or a 3-2-1 buy down. And what that says is that on a temporary basis, in the first year, your rate is going to be 2% below the normal rate. And in the second year, you'll be 1% below. It sort of stair steps it up. So I locked in a guy yesterday. He was, his sort of par rate would have been 6.25. He was willing to pay 1 point to permanently buy down the rate, and we got him to 5.75. Okay. Then he negotiated a seller buy down because these temporary buy downs have to be paid by the seller or the lender. Really hard for lenders to do. So it's mainly negotiated with the seller. So the seller's going to pay enough in closing costs. It's going to be applied to this temporary buy down that's going to allow him to have 3.75 in the first year, 4.75 in the second year, and then 3 through 30, he's going to be at 5.75. So he's sort of hedging his bet that if rates don't drop in the next 18 to 24 months, he at least is locked in at 5.75 over the life of the loan. The temporary buy down, a lot of people are sort of thinking that rates may come down, so let's use this to make the home more affordable until rates come down and they can refinance. So again, permanent, temporary, there's a cost to both. With the temporary, you get a lot of impact on your payment. It makes things much more affordable in those first 2 years. But you got to be comfortable if rates don't come down and you're never able to refinance, that you're comfortable with that payment that you're going to have years 3 through 30. But we can definitely look at situations with clients and help them. How do we construct an offer that's a winning offer and one that fits their family budget? And temporary buy downs and permanent buy downs are certainly ways, to make that happen and address this affordability issue that we have.
All right.
Good question.
Well, I appreciate your time. It's been very informative. So we will make sure that we post the link to the opt-out in the comments, and then some of the charts that Michael has for the information on the loan level. What was that again? Loan
level price adjustment.
Price adjustments. And so that way you guys can kind of have a graph and see what it's actually looking like for all that information. So Michael, if you'll just give us quickly your website, phone number, contact info in case anybody's interested in getting
we can put that below. You can reach me on my cell, 770-309-4923. That's probably the best way to get me. You could Google me, find me. I'm Michael McCollum, and we're with Certainty Home Lending. And I just appreciate you inviting me to be on the call. Grace, you do a great job. I always enjoy working with you. So anybody who's watching this and you need a great agent, definitely give Grace a call. She'll treat you well and do a good job for you.
Thank you, sir. I enjoy working with you. So that will conclude for today. Thanks you guys for watching. And I'm Grace Austin with Above the Call Home Services and Southern Classic Realtors. And again, we've been on the call with Michael McCollum of Certainty Home Loans.
Thanks so much.